Let's get back to the markets. This wild ride we've been watching over the past few trading sessions, is it indicative of a major change in sentiment? Joining us right now is MichaelTyler. He is Chief Investment Officer at Eastern Bank Wealth Management in Boston. And here on set is David Bianco. He is Chief U.S. Equity Strategist at Deutsche Bank. Michael, you think this is indicative of a major sentiment change. Why is that?
I do. Good morning. The reason is simply that if you look at what's been driving the market, it's clearly been the dividend plays. But as the economy continues to pick up steam, we're thinking that the growth stocks and the more mid-cycle acceleration stocks are likely to take charge. That doesn't mean that the market overall is going to be much stronger. We may trade sideways for a while, but it does mean, I think, that the dividend story is pretty much played out.
Hey, Michael, you are very concerned about what's beginning to take shape in the bond market. You think that this is just the beginning, the sell-off that we've seen?
I do. I think that interest rates are going to continue to work their way higher, particularly at the long end. And I don't think that's a bad thing. The reason that that might happen is that as the Fed continues to send out market signals that perhaps they're getting close to the end of tapering or the beginning of tapering and the end of their ultra easy money, that's a signal that they think the economy is getting stronger. The market's going to keep resisting that and saying, no, we're not ready yet. But sooner or later, the training wheels do come off, and I take that as a positive signal for equities and a negative signal for long-term interest rates.
But you also point out that people underestimate how badly bonds can fall. I mean, we had a guy who was talking to us earlier today who was saying that he still thinks a 40% in bonds, 60% in stocks works, because it's certainly what has worked. That sort of strategy has worked since 2009 on the lows. What do you tell people about bonds at this point?
Well, you should never be all or nothing. So certainly some diversification is still a good idea. But if you think about it, long-term bonds really are at risk to rising rates. If interest rates were to pop up 2 percentage points, which I'm not saying they will, but if they did, a 30-year bond would lose something like 30% of its value. That's huge, and people don't always recognize that.
Municipals, though, you think they're in better shape?
I think munis are okay. People are scared that state and local budgets have been weak, and as a result, muni yields have been trading higher than Treasury yields. That's unusual. Usually, muni yields are lower because of the tax benefits. We're looking at state and local budgets being slightly better than people are concerned about, mainly because of rising property tax revenues. And as a result, we think that munis are pretty good.
Okay. Gentlemen, thank you both very much. It's been a pleasure having you here.
Thank you.